net of the tiny volume of remaining COMEX open interest, foreign exchange gold by weight is globally fungible money and is self-arbitraging at real physical prices across the globe.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault, brought to you by Kinesis Money. And this is the show that goes beyond the headlines to uncover the truth about the precious metals industry. And joining us today is Kinesis' very own world-renowned whistleblower and precious metals industry expert, Mr. Andrew Maguire. And this week, we'll be answering Live from the Vault community questions. So let's head over to the UK now and let's join Andrew Maguire. All right, this week, we're going right to the Live from the Vault community question of the week. And this question is from Doug. Go ahead, Doug.
I have heard over the years that gold moves down when the markets are crashing because everyone is selling their gold to cover margin calls. However, I've also been taught that most people do not own gold. So how it could be possible that everyone's selling their gold when they don't have the gold to sell? I always felt like it was the government that was suppressing the price of gold during market crashes to give the impression that gold is no better off than stocks, and it too will crash. Just wanted to get your opinion about the strange relationship between market crashes and gold following the markets down.
Hey, thanks, Shane. Always good to see your smiling face, my friend. As you just said, if you were any better, you'd be twins. I love it. Anyway, look, it's so good to be with everybody. This is about education. It's really about taking questions, the best questions, or the most appropriate questions. They're all good questions, but the most appropriate question for what's happening right now. And actually, this question from Doug is great because it covers really a full spectrum of questions. And then we're trying to make this interesting for everybody. And obviously, we have everyone from institutional traders all the way through to brand new stackers and investors looking to understand really what is driving the often mystifying gold price setting process and who the current main actors are. So even an institutional who would know all that wants to know who's behind it, et cetera, et cetera. So hopefully this is, and we'll drill down so to provide a little context for those that don't know a lot of this stuff. Look, to provide better context for this wider range of subscribers, I'm going to answer Doug's question by walking through the most recent example of the current gold sell-off, which we've just seen, and who was behind it, and what was the objective. Now, Doug's question mirrored a lot of questions, and while this kind of deliberately created air pocket comes as no surprise to many subscribers, long-time subscribers, there were many other people rightly puzzling as to why gold suddenly reversed $150 per ounce from last week's tag of $34.50. Now, it's a good time to kind of quickly hop in on the charts to best illustrate just how counterintuitive the selling actually was, especially as we have very strong physical demand drivers powered by a race by central banks and sovereigns to sell dollars for gold into a series of higher stair steps. I'm going to show some links for that in a little while. But here, let's have a look at the charts. So this leads us to identify who really led the sudden gold sell-off, why they were behind it. And despite their best efforts, all it's done is to discover the next of a series of fresh, physically supported higher stair steps along the way, leading to $4,000 gold and $4,500 gold, but $4,000 being the immediate target. Now, I'm recording this at the pit open on Wednesday, and the Wednesday the 25th, which is also options expiry, and really a good time to sort of check through the footprints leading into it. Just to say though, this is a futures chart, which is trading in sync with spot, except that the futures chart, because it's a further out contract, is actually trading at around about a $13 to $14 premium to spot at this point. And that simply reflects the carry costs into this longer dated contract. So let's start off by looking at the spot 34.50 level, which is currently 34.64 futures. So that was here, it was higher. So this was pretty much the top of the range. So following very strong SGE, Chinese safe haven physical gold demand at spot 34.50, which had picked up into Friday the 13th, which is pretty much here, just before we opened up on the Monday after. So this was very strong demand and noted on Friday the 13th. And that was obviously to do with heightened war risks and one thing and another. And that followed through with more buying at the SGE Open, Chinese Open on Monday the 15th, spiking another $20 higher. And then we got a sudden, really essentially the start of a $150 waterfall into the 3,300 level. Now, again, there's about a $12, as you move down, about a $12 premium to futures. So this line represented 3,300 spot. So this picked up steam rapidly, and really at a time when gold really should be doing what it was saying on the box, namely acting as the safe haven. And the selling was extremely counterintuitive. And really this was what drew the attention of the first-tier liquidity providers, whose really job it is to ensure Basel III NSFR compliance at the global-facing FX gold fixes, and were having to supply gold into those fixes into this series of lower prices. And for reference, this is obviously before the PM fix, so I've just marked in where the AM fix was this morning. So the reason I'm showing this is really because we want to step through the footprints as it provides a timely example of how, as Doug puts it, he said, given most people do not own gold, how can it be possible that everyone is selling their gold? And that, we need to answer that question. And this also leads into his questioning about government suppressing the price of gold. So this is a really good question. We're going to drill down into his whole question. Now, the first thing we need to do is differentiate the difference between the tiny percentage of Western-facing funds and people who own or stack real physical gold. There's a big difference. And the physical buyers never sell their gold versus the paper gold traders who place really just high leverage futures bets targeting a higher or a lower cash settled gold price expectation. Now, we call them obviously the speculators. Now, these paper or synthetic gold traders what they're doing is borrowing gold from what is essentially a cartel-rigged casino environment, with the house pitched against them. Now, we call it the COMEX casino, where you can borrow exposure to paper gold with only really 4% of skin in the game, which makes it very attractive for speculators. Now, that means a speculator can currently control 100 ounces, a contract of gold worth $340,000 for a tiny $15,000. Now, the trouble is, leverage works both ways. And in this case, these speculators have been buying gold for the similar reasons as physical buyers do, except for one very big difference. Paper gold can be created out of thin air, while physical gold is limited in supply and is extremely sensitive to supply-demand fundamentals, because physical gold is globally fungible. This is the important part. It's globally fungible. No matter where you go in the world, gold is recognized as money, and it's the same value around the world, whatever that value of that gold is each day. So that each physical ounce, kilo, ton, that is purchased in the physical markets tightens a single source of available supply and incentivizes the next seller to raise the price to get the best price, as you would do in a normal market environment. Now, quite the opposite if a speculator buys or sells freshly generated paper gold futures contracts, which are not physically settled, and the resulting supply and demand price that comes out of that is purely synthetic. Now, while this COMEX tail wagging the 10 times larger physical dog does influence the 2 daily global gold fixes, it's only to the degree where the COMEX pit managers can actually lay off the liability into a shrinking number of siloed COMEX speculators. And as we can see, the scope of being able to do so is fast shrinking as the real global facing physical dog begins to actually wag the speculators raters right off the COMEX tail. Now, while physical buyers are competing to exchange fiat for gold, or actually maybe just to help hedge their wealth against rapidly debasing debt-backed dollars or pounds or yens, whatever it is, and this is done into a limited global supply. Now, given the exponential pace of fiat money debasement, you just have to go down to the grocery market. You just have to look any chart and you will see just how many more dollars it takes to buy anything. So what the physical guys do is look at these fiat money debasements and value gold. As a consequence, value gold literally hundreds to thousands of dollars higher than is currently being offered for sale, because it's being offered for sale in a diluted form. And it's not that gold is actually going up. It's simply that the same ounce of gold, the ounce of gold benchmarks really the loss of purchasing power of no matter what currency you're in, the full range of rapidly debasing fiat currencies. Now, each day, each month, quarter, year, decade that goes by, it simply requires more freshly printed dollars to buy the same ounce of gold. That's really what's happening to gold. Now, in contrast, highly leveraged casino gold speculators, and they're literally corralled inside the COMEX casino, and they have US traders have no ability to trade the spot delivery physical markets. So, in consequence, they have no visibility into the real wholesale market supply demand fundamentals, whereas the house does. So, with this knowledge, the house knows exactly how many chips to lend to create enough liquidity to set a non-deliverable casino ticker price for gold. You know, when you're in a casino, you see a ticker price going on. It could be racing, it could be anything. I mean, that's their number, that's their presentation. And this is how the cartel generates regular wash and rinse cycles. And that's something we're seeing now, which is why this question is pertinent. Now, given the casino pit managers hold the book on the chips borrowed from them on margin, and the house runs this ticker the specs actually knee-jerk react to, in aggregate, the house market makers know exactly where the speculators will be forced to sell their positions. And just like any other casino setup, the house wins 95% of the time. And as the LBMA CME market makers act as a cartel, it's really sanctioned wire fraud by any other name. Now, while there are legitimate reasons for trading futures contracts, that could be to trade physical positions, producer or refiner hedging, these bets are not speculative and tend to be sticky in nature, and they're not to any degree asymmetrically imbalanced. That it is a legitimate hedge, meaning that these positions which is part of the open interest, which is why you have to look at the breakdown of it. They're not leveraged and they can't be rinsed out, but they can be called on for one-to-one physical delivery at any time, which is something we see sometimes at the back door of the COMEX. However, what we're focusing on, we're actually going to focus, we're really focusing on the leveraged speculators who are simply seeking to profit from price movements for cash settlement. Usually they're on the long side. So it's this simple. Once speculators have borrowed enough chips and the price jumped on for the right evidences the house is on the losing side of that trade, they move in. But this is the key, in unison, because they're market makers and they have a footprint in the FX spot markets, which COMEX traders can have no visibility into or are unable to trade, and they have a footprint in the COMEX. So, but in unison, they can ring the register on these borrowed positions, or as Doug rightly puts it, the exact point where speculators can be margin called by the pit managers to replay these borrowings. So that's the how. And now, using the current sell-off footprints, who and why was gold called down by? Now, given all the gold supply that hit the market emanated out of the 96% leveraged COMEX futures markets, but into this very strong but unleveraged physical, this selling was into unleveraged physical buying. Our liquidity providers dug down into the footprints to determine who was behind this latest round of extremely counterintuitive driven gold selling that commenced on Friday the 13th in gold. We looked at that on the chart. Now, each footprint on that Friday indicated it was likely Citi's trading desk breaking rank from all the other bullion banks actively bullish gold calls. In other words, gold prices. Let's call this section perhaps Citi versus Goldman, two Goliaths here. But it could also be called Citi versus every other bullion bank. Now, by Tuesday, the 17th, we had word that Citi had created a futures market sell ignition. And what it was they'd done it was they were tricking in the captive producers that they finance to hedge production, selling it forward all the way into 2026. So to me, why would you be to that aggressive degree? This was extremely counterintuitive. So in the face, and especially when you look at the numbers they were calling, so in the face of really very strong central bank gold buying, Citi openly broke rank from every single other bullion bank, calling for a rotation out of gold futures and the GLD ETFs, the gold ETFs, to literally dump those to buy risk assets. Now, hence the waterfall selling in gold and the rally in stocks. Now, to suck in momentum selling directly after the London Open on Wednesday, Citi finally came out on the wires, openly, publicly talking gold down, going as far as to call gold down as low as $2,500. Now, while that outrageously counterintuitive price target was deliberately designed to attract the puzzled mainstream media attention, and I saw Bloomberg on there asking questions about it, reading between the lines, they were actually really hinting at a bearish consolidation at $3,000, probably where they really were trying to buy it back and nail these producers and literally rob them of as they were targeting lower, and literally buy back what these guys were selling. However, Goldman Sachs immediately and publicly, deliberately countered Citi's bearish call, reaffirming their long-standing gold targets of 3,700 and 4,000 for the first quarter, by 4,000 by the first quarter of 2026. So here's Goldman's assessment that directly followed Citi. Since then, many other banks have come out to counter this obvious attempt to suck in momentum sellers. Now, UBS was on Bloomberg this morning, this is Wednesday, based on tight supply and very strong central bank buying, reaffirming 3,700 to 4,000 gold as fair value. So really, this is on every other bank is long. So the question is, why is this deliberately driven price divergence happening? It's this simple. Citi and JP Morgan are the primary agent stick handlers for the deeply offside, officially held OCC FX bets. If you remember, we talked about the Office of the Comptroller bets. We're going to show them in a second. And these are the bets that have been accrued over time against unallocated gold. Now, I will stress unallocated gold. This is FX bets that should be NSFR compliant, are not NSFR compliant, are not Basel III compliant. And so what they're doing is but when they get demanded for delivery, they have to be delivered at the fixes. So these bets really, they're attempting to mark these positions to market later today, which is Wednesday the 25th, into gold futures options expiry, followed by even larger Office of the Comptroller FX bets on Monday the 30th. So here are the actors. And as we looked at in our last couple of episodes, the CME-LBMA Cartel Alliance leverages the distance between the very recently extended non-Basel III compliant allowable 20% unallocated gold haircut that they're allowed to have when they trade amongst themselves. And really, it's pitched against, though, fully compliant Basel III gold. Now, the lack of Basel III first-tier high-quality liquid asset FX gold compliance in the OCC bets is exposed in the OCC small print. Have a look at this. And it says, under the CCR gold derivatives, they're considered precious metals derivative contracts rather than an exchange rate derivative contract. And what they're saying is it results in an increase in reported precious metals derivative contracts compared with prior quarters. No sugar share look. Also, this deliberately dragged out first quarter of March 2025 OCC report still reflects data from the fourth quarter of 2024. There is absolutely no good reason for this hugely tardy reporting delay to extend all the way to the second quarter of 2025. All our feedback suggests that the next report will uncover a big drain of this unallocated gold exiting these bearish bets. Now, while almost certainly benefiting from taking the long side of tricked in, otherwise unnecessary, this is the part that really annoys me. It's unnecessary producer selling. Citi's purely synthetic price target is laughably simplistic. And liquidity providers report that this week's bear call has Shanghai Exchange International Exchange and the SGE on-market traders stealthily taking the long side of unallocated gold sales, coiling gold for a physically driven catch-up rally. In fact, UBS referred to unallocated gold being drained for delivery in this morning's Bloomberg interview, calling it a concern for those for unallocated gold and the risks that presents to those banks. Now, whereas siloed inside the COMEX bubble, the majority of CTAs, speculators, have no visibility into the physical markets, or that the cash-settled COMEX they are trading has now become the tail being wagged by the physical dog.
So the idea was to try and gaslight as many blinkered CTAs, commodity trading advisors, into selling longs and or borrowing chips to naked short heavily leveraged borrowed gold in the hope of targeting a synthetic cash settle gap close into the future spot 2900 level. Why was this important? Because it's simply the 200-day moving average. However, the last time that gold came anywhere close to touching the 200-day moving average and was even front run at that point was at spot gold $2,000, which was exactly when the Shanghai Futures Exchange launched. Now, at this point here, and we talked about it at the time, and it wasn't just Citi, it was two or three other banks were literally questioning that gold. They were suggesting, in fact, Citi was calling for a retracement to $1,600. So all the way back to down here, this is what they were expecting. And that was absolutely the wrong call, because the Shanghai Futures Exchange and what they hadn't accounted for isn't a synthetic market. You have to own a bar before you can buy or sell it. And so therefore, a physically settled price began to be discovered after the 1st of March Shanghai contract launched, driving gold into a physically settled supply-demand price $1,500 higher per ounce. And along the way, they had to short cover.
Now, while we've got empirical evidence that the 5 banks listed in this OCC report are behind every end-of-month OPEX mark-to-market capping event, Goldman and the Bank of America and UBS have managed to exit their 5-year OCC derivative positions. If you look at it, you can see they have no 5-year exposure and have been calling for higher gold prices, leaving Citi and JP Morgan to act as the primary agent banks' stick handlers. But along with every other bullion bank facing the global physical markets, they're also long NSFR compliant first tier, high quality liquid asset, fully allocated physical gold for their own books. That is the part that is really annoying. And guess who will be first to take the long side of the led by the nose CTA sellers and poor producers who have ended up selling forward production at a discount?
Now, tracking from when the Shanghai Futures Exchange was launched, there's been multiple attempts to cap and suck in automated momentum sellers ahead of every OCC, and this is pretty much where the Bank of International Settlements close their bets. They're marked to market at the OCC price. So here we go, a series of higher highs, and as we move along to where we are now, that has been consistently higher. These closes, the Bank of International Settlements closes, have been consistently higher. So essentially, we're saying we've historically become accustomed to every single OPEX expiry being a heavy event. Now, as we exit the end of the second quarter, there are far too rinsable, non-sticky longs to generate the necessary sell ignition for commercial shorts to hedge against a surge in central bank sovereign and institutional physical demand. Very few blinkered siloed CTAs have any long exposure to either gold futures or exchange traded funds. So these predatory swap dealers will be reliant on taking the long side of borrowed CTA shorts. That's what's happened every single time along the way higher. Into an impossible to hide shrinkage or contraction or exit of COMEX open interest, this measuring the open interest. And this was, if we just go back to 2020, this is they were literally dealing with 8,000 contracts. Apologies, 800,000 contracts, which now have almost been cut in half. And current open interest is, in fact, it's slightly less than this. It's actually 5,000 contracts less than this. But essentially, as it's settled out. So essentially, almost half. You're talking about 400 million ounces since its peak in 2000. Why is that? Because price discovery is increasingly being set by Eastern physical exchanges where the supply and demand of real physical bars are setting the global price. And as we've been tracking, China stepped in to launch the Shanghai Futures Exchange on the 1st of March 2024, overnight injecting sufficient physical market liquidity to wrest control of the global supply-demand price-setting process. As a result, the Western LBMA and CME cartel controlling the cash-settled unallocated gold market immediately began to be drained of sufficient paper market liquidity to be able to equitably cash-settle a tidal wave of 20% unallocated FX gold haircut in-house. It was being called for delivery. This simply forced the cartel to raise the price of unallocated gold being alchemized for physical delivery at the Basel III compliant Loco London FX fixes. So under this smoke and mirrors action, a growing number of Western-facing exchanges are now geared up to physically settled foreign exchange gold transactions, and these exchanges are increasingly taking control of the global Basel III FX prices, which is why gold is evidencing a series of higher stair-step prices, which are backwashing into Loco London Basel III compliant global fixes. And here's where the last one was. An increasing number of Western-facing physical exchanges are geared to really easily alchemize mispriced, leveraged, unallocated paper gold presented at the deliverable Loco London fixes. The problem paper shorts are running into is net of the tiny volume of remaining COMEX open interest. Foreign exchange gold by weight is globally fungible money and is self-arbitraging at real physical prices across the globe. Now, the latest attempts to gaslight siloed, blinkered, leveraged CME, LBMA, unallocated gold traders into targeting these synthetic moving averages has zero merit, incentivizing every physical-facing central bank, sovereign and bullion bank, including Citi, and all the other bullion banks to buy the dip. Now, if momentums do add naked gold shorts to fund Citi's risk market rotation trade, it will serve to suck in rehypothecated leased gold into a growing number of Western-facing physical exchanges. The latest one again being reported here, this time by Bloomberg. We're also now seeing global prices being determined in silver, which, while silver is not Basel III NSFR compliant, the global FX price being set Loco London is deliverable outside the LBMA ecosystem, exposing the cartel to the short side of very strong global-facing FX silver demand, which they cannot supply unallocated silver into at current prices. And because they're not doing it, it's coming from producers, it's coming directly to these exchanges and starving the LBMA of product. So they're increasingly being forced to convert leveraged unallocated positions for delivery while they still can. Now, speaking of silver, just look at how these official OCC bets were driven down to the exact 35.20 OPEX sweet spot. This was done yesterday ahead of options expiry today. Now, this to me is wire fraud by any other name, because you've got an aggregation of banks working together. Now, the silver futures were flash sold through targeted long stops. We saw that here after the fix, of course, through targeted long stops, right back into this 35.20 bull pivot confluence with this 35.20 OPEX sweet spot. So, an exact hit. And it evidenced very, very large commercial short covering. Notably, the spot low of the day was actually 10 cents higher. And where are we seeing the capping now into options? Exactly where the COT cutoff was. And that's the same in gold, which is also experiencing capping. And just to provide a little context, if we look at the 4-hour charts, and we talked about this resistance line that has finally been broken through, has now become support. So really anything above here is really going to have an effect of driving the price substantially higher into a minimum of $38. And I mean short-term $38. In the bigger picture, gold is at least targeting the 40 level on its way, where there will be sufficient stops to drive it up into its all-time highs. And we're just moving into season.
So bottom line, when Citi is so obviously attempting to trick in fresh leverage short selling to finance this leverage rotation into risk markets, every single bullion bank, including Citi, are taking the long side of these sellers, as is evident in this Financial Times report. Central banks plan to boost gold reserves and trim dollar holdings. There we are. And to illustrate there's very limited physical on offer into central bank global demand, which has been responsible for soaking up all the physical supplies ever put on offer, at any price that is, doesn't matter if it's high or lower. An increasing number of global central banks are seeking to actually now repatriate gold they already own back to their own vaults. Again, Financial Times. Central bank buying and gold repatriation stepped up significantly after physical gold was reclassified as a first-tier NSFR compliant high-quality liquid asset. As also reported here, foreign central banks continue to want their gold back.
All right. Thank you, Andrew, for that amazing question. I think the entire community is going to agree with me when I say that you've just put a bright, shiny light right down the casino cartel rabbit hole. And now, just to cover off on the other questions from the community about what do you expect in the short term here, and what's your take on things that are happening right now?
Sure thing, Shane. Obviously, central bank demand alone is going to underpin a series of higher stair steps. But very short term, while no one will chase anything until all the options or these OCC bets are squared today and the OCC bets on Monday, this is what we're seeing. And obviously, nobody's chasing anything. It's being capped heavily. These are big derivative bets that could take down the too big to fail bullion banks. We're talking about one component of a 2 quadrillion derivative market, and gold is a very big aspect, and silver is a very big aspect of that. Now, the gold futures OPEX structure for today, the sweet spot is 33.50. Go figure, look at the chart. With every strong resistance, with really, really strong resistance at 3,400. So it's not going there before expiry. Hence the price capping. And as is always the case, into synthetic COMEX-centric options price suppression events, no one will be chasing anything above the options sweet spot. But liquidity providers report these capping shorts are once again stealthily being alchemized, very quietly, coiling gold for a physically driven catch-up rally. Now, liquidity providers are reaffirming the strong Asian safe haven demand is definitely at odds with the usual official gold capping events, which historically, they always follow a geopolitically driven reason to buy gold. You know, every time there's a geopolitical event, gold spikes higher, immediately gets taken back down again. Why? Because it's immediate FX market intervention. They don't want people racing into gold, literally. But once that initial gaming plays out, then gold tends to rise. But by design, the rise won't be attributed to the undiluted race into safe haven physical gold. Of course not. They don't want you to see it. Spot silver demand is also evident into Eastern markets. But as we identified earlier, silver futures were flash sold through targeted long stops to exactly hit its 35-20 options sweet spot, where immediately it evidenced obvious and very large house short covering. Notably, the spot low of the day, was 10 cents higher than the futures price, which should not be happening. And what it illustrates is a mispriced market. And while Citi and all of these and those hangers on haven't publicly tried to talk silver down into the current 35-20 sweet spot, they're also reported to be behind the capping in silver futures. Spot silver is trading at a consistent premium to silver futures. That shouldn't be happening. Currently today it's 6 cents, but it's been as high as 12 cents or $600 per contract. Now, given though through the last 4 sessions, silver open interest has evidenced 9,682 or 1,500 tons rinsed out, even averaging the spot premium to futures at, say, 6 cents, that's close to $3 million of house positions that have been rinsed out by the pit managers. That's the game. This is telegraphing foreign exchange silver is being locked in, though, because the foreign exchange price is higher than the futures price. Because it's being locked in at the FX fixes to future at premiums. And it also indicates the imminently expiring July COMEX silver contract, which goes into delivery at the end of June, will be stood for delivery and will be drained of cheap, immediately accessible silver and the current open interest that remains. So the potential delivery exposure right now is a very large 6,000 tons. And while a lot of these positions will, of course, they'll be rolled into the upcoming September contract, there are only 2 sessions left to actually deliver the last 1.4 tons of June deliveries. Why the heck anyone would hang on to the last day to deliver a June delivery that should have actually been delivered at the end of May? So to sum up, basically, both of these bid pulled efforts in gold and silver are options, OCC related ahead of options expiry today and OCC related capping. And it's being led by Citi, stick handling official OCC bets. And while we expected a last kick at the can ahead of US Basel III compliance, all it has achieved is to secure the next higher, globally determined, higher price stair step with almost no paper speculators on board to rinse. Just to finish up, though, we have contacts on the ground and we'll be closely monitoring the upcoming 17th BRICS Summit in Rio on the 6th and the 7th of July. And we're going to provide a full update in our last episode that will be recorded on the 9th of July. So BRICS, remember, is a platform for accelerating financial multipolarity with a view to expanding the new development bank so as to bolster national currencies in intra-BRICS trade benchmarked to gold. That's the key thing. And with gold markets now being discovered in Ava, and prices now being discovered in Asia, as Bloomberg draws attention to, it provides the BRICS autonomy. Gold is already being price discovered in the Eastern physically backed markets. The formalizing of the financial infrastructures to support liquid global settlement is the final piece of the puzzle, and it will be the death knell of the COMEX if it does not become Basel III compliant. We've talked about it before. Yeah, you can avoid being Basel III compliant. You can keep playing your paper game, but you've got less and less people to actually cover your exposure into. So you're in trouble. And simply what happens is you're going to influence the fixed price through your COMEX gaming, and that's going to be delivered. And then they're going to turn around on you. And what they're doing in silver right now is loading up at the back door and taking it and literally draining those vaults. So unless it becomes Basel III compliant, goodbye. Now, gold is strengthening the BRICS currencies at the expense of the dollar. In case you haven't seen the ECB financial stability review, drawing attention to the unallocated paper gold to physical imbalance, identifying large foreign counterparty derivative exposures that must be brought back into essentially rising prices. So the only question left to ask our dear subscribers is, how prepared are you to protect your wealth from the next leg of the dollar and related fiat debasements? How much physical gold and silver do you own right now?
All right, that wraps up another episode of Live from the Vault, brought to you by Kinesis Money. And a big thank you to Andrew Maguire for sharing his deep market knowledge. And thanks to the Live from the Vault community member, Mr. Doug, over there for that detailed question, by the way. And thank you for tuning in and being a part of this growing global community here at Live from the Vault. Now, if you're new here, make sure you subscribe. And if you click on that black bell right there, you'll be the first to know when we go live. All right. And now, if you've been with us for a while, please help keep spreading the word about this show and give us a like. It really helps the show. And also share this episode with someone who really needs to hear this information. So get your questions into Andrew Maguire. All you got to do is just look below. We're putting a link down there and ask your best question. You never know. You might even be selected for next week's episode of Live from the Vault. And with that, we'll be back next week with information that you just won't find on the mainstream media. So until then, remember this: buy physical, make sure it's backed 1-to-1, and we'll see you next week. Bye for now.